Hello and welcome, everyone. Welcome to Spark Rentals, Facebook Live, podcast, YouTube, everything. Thanks for tuning in, and please let us know where you're tuning in from. And then during this, please let us know if you have any questions. And it doesn't even have to pertain to this. Just let us know what questions you might have. Last week, we talked with Nora Dunn about how to travel the world for less than living at home, which Brian knows all about.
All about the
And
nomadic lifestyle.
serious, the good, the bad, and the ugly. But this week we're going to be discussing financing for LLC-owned properties, which has its own nuances. So, Brian, I'm handing it off to you. Let's talk about real quick about traditional mortgage lenders and how that works with LLCs.
Sure. Well, that's one of the first questions that a lot of people have when they first get into real estate investing is, I want to create a legal entity like an LLC to buy properties with, but will I then qualify for a mortgage loan to buy a property? And the answer is yes, in some cases. There are some traditional mortgage loan programs that do allow legal entity buyers. That being said, they do require you to sign a personal guarantee. So you're still on the hook, right? You're still signing on the bottom line personally. So if you default on that loan, the lender's going to come after you personally, not just the LLC's assets, the property and maybe any other properties that LLC owns. They're also going to come after you and your house and your dog and your car and
the dog could be a good thing sometimes. No,
it could
just
be a
kidding.
show dog. Like maybe it's valuable. I don't know. But yeah, that's usually a requirement with any of these loans. So that's not unique to traditional mortgage lenders. But there are some downsides that are unique to traditional mortgage lenders. One is that they do report on your credit, which may not seem like a bad thing. You're planning on paying this on time in full every month, of course. But one or two mortgages on your credit is good for your credit. 10 or 15 mortgages on your credit, probably not so great for your credit. But the bigger issue is that most of these traditional mortgage programs, they put a maximum on the number of mortgages that you can have reporting on your credit before you no longer qualify for the mortgage. And in most cases, that maximum is 4 mortgages reporting on your credit.
Just out of curiosity. Sorry, I interrupted. I always do.
It's all right. We're among friends here.
LLC, does it report to the LLCs because you have an EIN? So does it report to the LLC's credit, the business, or your individual?
It can report for business credit, but normally it reports on personal. It always reports on your personal credit. In some cases, they report for your business credit, but in most cases, they just stick with personal because that's what traditional mortgage lenders are used to. They're set up for personal credit reporting. So.
Mm-hmm.
So, yeah, I mean, that's a problem when you basically have a cap of 4 traditional mortgages total. In some traditional loan programs do have a cap of 10 mortgages allowed reporting on your credit, before they disqualify you as a borrower. But in most cases, it's 4. So that means that for your first couple properties, you can take out a conventional mortgage loan, but you hit that ceiling really quickly. These are usually the cheapest option, but not by much. I mean, we're not talking about a big difference in pricing here. Maybe a quarter of a point or something. So, yeah, they are a viable option for your first couple properties is the bottom line. So you can take out a conventional mortgage loan to buy an LLC-owned property, but don't count on this as your permanent solution for financing your investment properties. Which takes us to the next option. So if you buy a fixer-upper, which is often the bread and butter of real estate investors, what most people do is they take out a hard money loan. So these are short-term loans that are purchase rehab loans. So they'll lend you a certain percentage of the purchase price, usually up to 80 or 90% of the purchase price. They'll also lend you usually 100% of the renovation costs. And then as soon as the property has been completed, as soon as all the renovations are finished, you have to either sell the property as a flip or refinance it as a BRRRR deal. And if you're not familiar with that acronym.
Probably good to know also that for the rehab portion, some banks require like an escrow account, and then you have to show them the bill, and then is that typically how that goes, or do they?
So what usually happens with hard money loans is they'll set up a draw schedule. So
Mhm.
if it's, I'm just going to make up numbers here. If it's $50,000 in renovation costs, there might be 5 different draws of $10,000 a piece. So you go out and you make the first $10,000 worth of repairs. You pay for that yourself up front, and then the lender sends out an inspector to review the work, make sure that that it's done at a minimum quality level that they accept, and then they reimburse you that $10,000 for those renovations, and then you move on to the next draw and you do the next $10,000 worth of repairs. And again, you're paying upfront for materials and so forth. And then the hard money lender reimburses you a draw at a time until all of the renovations are complete. So you definitely don't want to let the contractors get ahead of you there. You want to make sure that you are not paying them upfront for work that has not been completed. Ideally, you can just pay the contractor out of the draw from the lender, so you're not coming out of pocket for the labor, but you are still going to have to come out of pocket for their materials. So yeah, hard money loans, they're expensive, but they're pretty quick and flexible, and they're short term, right? So who cares if you're paying 12% interest for
Mhm.
4 or 5 months, right? It's the upfront fees and so forth. So what's going on over there, Deni?
I thought I turned it off. Anyway.
No worries. You know how many times I've done that on this podcast? So anyway, so that's number 2 is hard money lenders, which are short-term purchase rehab lenders. As soon as the renovations are finished, you either sell the property as a flip or you refinance it with a long-term mortgage. Which brings us to, who do you refinance with for a long-term mortgage on a rental property? And the answer that a lot of real estate investors use is what we're called portfolio lenders. So, and in some cases, they're the exact same lenders as hard money lenders. They just offer both different types of loans. So portfolio lenders keep these loans within their own portfolios, hence the name. They're not bundling and selling these loans off to big corporate investors the way that traditional mortgage lenders do. That's what happens when you go out and you borrow a conventional mortgage loan from a bank, is within a month or two, they just bundle it and sell it off to someone like Wells Fargo or Bank of America. And then that's who you pay your loan to for the rest of the 30 years or whatever. Portfolio lenders, they keep the loan in-house on their own books. So that makes these loans much more flexible than conventional mortgage loans, which have to fit within preset programs, usually by Fannie Mae or Freddie Mac or by a government-sponsored loan like FHA or VA. So they're a little bit more expensive than conventional loans, but not much. And these are really designed for investors, for legal entities like LLCs. They do require a personal guarantee, just like a conventional mortgage loan. Credit still matters a lot, but they don't typically report to the credit bureaus, and there is no limit for how many mortgages you can have reporting to the credit bureaus. And most of these do not verify your personal income. Your income is not a factor in these. Instead, what they usually use is a cash flow calculation called debt service coverage ratio, or DSCR for short. And that is a measure of how well the rental property itself cash flows. They want to make sure that you're not losing money on this property every month. So there is usually a minimum DSCR for each one of these loans. Does that make sense?
Absolutely. So do you think some people probably start out, get 4 traditional loans and then they want to get more and they move into the portfolio?
That's what a lot of
Lender
people
part of
do.
things?
Personally, I think you're just as well off going directly to the portfolio lenders for your long-term rental property mortgages. Start establishing relationships with these lenders. You do want to have relationships with more than one in case one of them turns you down. Maybe they just don't happen to like that deal that you're doing. And the more loans that you do with a specific lender, the more trust you build up with that lender, and you build an actual relationship with them. I mean, this is not like a faceless, soulless corporation that you're working with. It's typically a small company, a small lender. You're going to be working with the same 1 or 2 people every time. Same underwriters are going to be underwriting your loans, and they'll give you better terms. They'll give you better interest rates, lower fees, lower points as you establish a relationship with them, because lenders price loans based on risk, right? I mean, that's that is what determines how much they're going to charge.
Right.
So, the higher the risk, the more of a return they need to earn to justify that risk. So, as you become a lower risk borrower, they charge you less. And that's the bottom line. So, if I were starting from scratch today as a rental investor, I would not mess around at all with conventional mortgage lenders. I would go straight to portfolio lenders for long-term mortgages.
If we only knew this.
Oh,
Back in
the things I didn't know when I was in my 20s, starting out as a real estate investor, you could fill 10 books with the stuff I didn't know about real estate investing. Obviously there's a ton of stuff I don't know about other stuff too, but yeah, I mean, I did not know what I was doing, which is why I ended up losing money on a lot of those properties when I first started real estate investing, and why we do things like maintain our blog and our podcast and offer
Right.
free classes, so that hopefully you can learn some of these lessons the easy way rather than the hard and expensive way that I did.
It's like our mistakes and losses became tuition, college kind of for.
That's definitely how I look at my losses in real estate in the early years. Is it's the tuition of education,
Right.
right? Some people, when they take a loss on a real estate investment, they run for the hills and they never touch real estate again. At that point, it is just a straight loss. If you look at it as the cost of education and you move on and do better with your next deal, then it's tuition, right? It's the cost of education.
Yes, absolutely. So let's talk a little bit about unsecured business lines of credit. How does this fall into this?
Yeah. So instead of going out and borrowing a mortgage loan, like a fixed installment loan, you can use rotating lines of credit, and in particular, unsecured business lines of credit. You can also use secured lines of credit like HELOCs, whether against your personal home or against existing rental properties you own that have good equity already built up. But as a real estate investor, the bottom line here is that you do qualify for business credit, both in the form of rotating lines of credit and also unsecured business credit cards, both of which you can basically use the same way. I can hear the first objection and question that people are thinking when they hear that is, well, wait a minute, credit cards are not designed for pulling cash out. Most of them have a much lower cash advance limit than the actual total credit limit, and they charge hefty cash advance fees. You can get around that basically with tools like Plastic, spelled with a Q at the end instead of a C. So the way it works is they basically charge you as if it's a purchase, and then they give you the cash and they take their cut. I think Plastic charges 2.9% for their service, which is lower than most cash advance fees. Typical cash advance fees are around 4%, give or take a percentage point.
Yeah, they're ridiculous.
Yeah, and so that's expensive. But the bigger issue too is that there is a limit on cash advances that's lower than your total credit card limit. Plastic gets around that too. So you can use your business credit cards as a line of credit. You can pull money out, and you can also put obviously materials like right on the card itself. You can literally go to Home Depot or Lowe's, whatever, and swipe the card, or you can give the card number to your contractor if you really trust them.
Only if you really trust them.
Yeah, if you really, really trust them to cover materials. And a good chunk of that 2.9% that you're paying to someone like Plastic, a good chunk of that you might get back in the form of rewards, like travel reward points, or cash back. So, you might get half or even most of that 2.9% back in the form of rewards. So it can be close to a net neutral or a fee neutral form of borrowing. Now, the other downside here is that you're going to have high interest rates on these. But you shouldn't use this for like 30-year financing, right? Like it shouldn't take the place of a 30-year mortgage loan. But you can use it for things like renovations, or if you're buying a low cost property that you think you can pay it off within a year or two, you can do that. You can use it for a down payment on a property. So you go to
an
an
auction that's inexpensive.
Yeah. So if you go to a portfolio lender and let's say they lend you 80% of the purchase price of a rental property, you could use your unsecured business credit lines or your credit cards for the other 20%. And then you're going to want to pay that off really quickly, right? So that you're not carrying a balance that's costing you 15% interest, 20% interest, sometimes even worse than that. I did this once. I put a property and its renovations on a credit card, and then I just made that my number one financial priority, and I paid it off within 6 or 7 months or something. So that is an option. And bear in mind that as a business owner, you can qualify for higher credit balances potentially than you might qualify for for a personal credit card. So, we've worked with a company called Fund and Grow, and we'll include a link to it here in the comments and the show notes. They help you open between $100,000 and $250,000 in total business credit, unsecured business credit, within a year. They do it over the course of 3 fundraising sessions, basically, like one when you first open the account, another one in about 6 months, and then another one after about a year. And they scrub your credit report in between each round of fundraising to remove all of the past applications and stuff. And they really work with you and do all the heavy lifting. They do charge a one-time upfront fee for their service, but it's totally worth it. They're great to work with. So that is another option on the table as you're trying to build out like a financing toolkit, if we're going to be nerdy about it. So keep that in mind as an option to fund some of these real estate deals as an LLC or whatever legal entity that you're choosing to use.
Right.
All right. The 5th option for financing deals through an LLC, or if you're using a legal entity to buy properties, is friends and family. It's oldie but goodie. As you establish a track record of success with your real estate investments, start bragging about how well you've done in a tasteful way, of course. But, so a lot of times your friends and family are willing to invest in your success, right? And you can pay them interest instead of paying a lender or a credit card company or a HELOC.
Which could be appealing to them as well.
Yeah. So, in an ideal world, it's a win-win where they're collecting high interest or a reasonable interest rate on their money, and they feel secure in lending you that money, as if you are someone who is experienced in real estate investing and you do have a good track record of success. This tends to work best when they come to you rather than you going out and hitting them up with your palm out for money. But people are going to ask you about what you're up to, right? What you're up to work-wise, and you can talk about some of the properties that you're investing in and some of the returns that you've seen on them. You can talk about things that challenges that you faced, and the creative ways that you overcame those challenges and still managed to make money. All that stuff. And the more interest that they show in this, you can take that as a sign that you can keep talking to them about it, and potentially raise the idea of them working with you in some way, shape, or form on your next investment. So just make sure that
amongst friends.
Yeah, just make sure that you are that you're not gambling with your friends and family's money. Only do this if you really do have a deeply established track record, and you are an experienced real estate investor. While you're building that experience, stick with portfolio lenders, traditional mortgage lenders.
The last thing you want is an issue with a family or friend.
Yeah, because the collateral here is your relationship with them, and if you burn that, it's not just a financial loss for you; it's also the loss of your close family and friends. Deni, is there anything else you want to bring up or cover on this topic of borrowing money for LLC-owned properties?
No, I just think that it's good that everybody has all these options, because, back in the day when I was getting involved, there was call the mortgage lady, that's that's what you had. Right. So there's a lot of creative options out there. So there's really very little to stop you once you're ready to get involved.
Absolutely. And if you weren't able to write down every single thing that we listed there, we'll link to resources where you can see all of these options listed out and some reputable lenders from each category to check out. So on that note, we're going to wrap it up, and we will catch you on the flip side.
See you next Tuesday. Bye-bye.